gets going, I will turn it over to you.
All right. Thank you, everyone, for attending or logging in. This is our July Director's Cut talking about May production, and I'm calling it the Fantastic Four. I think there's four important things the numbers are telling us, and after I talk the numbers through a little bit, we'll come back to that. But want to point out that crude prices have really dropped in the last week. We're into what many of us feared would happen in 2015 is a double dip in prices. And so today's posted price, less than $41 a barrel for North Dakota Sweet. Not quite as bad as it got to back in January and February, but it's headed that direction. And obviously concerns about Chinese demand and European demand with the financial problems in Greece and the stock market problems in China. Serious problems or concerns about overproduction and loss of demand. 73 rigs operating today, which is the lowest we've been since November of 2009. So you got to go back 6 years in order to find a rig count this low. And that represents a 67% drop in rig count. Interestingly enough, there's only been a 48% drop in permit applications. So companies are still really optimistic about Bakken drilling. It's just more a matter of when, not if. And so what we see companies doing is positioning themselves for those magic price points. And consensus is pretty much that $65, when it looks like that price is sustainable, the fracking crews come out, and at $70, the drilling rigs will go back to work in a more significant way. We had 114 wells completed in May, which was up just a bit, and production up, as you obviously saw, about 32,000 barrels a day. Production on Fort Berthold Reservation was flat, and natural gas prices are weak along with oil, but gas capture stayed strong at 82%. So we didn't lose any ground there, even though we had some pretty significant increases. We had a 5.5% increase in gas production and almost 3% increase in oil production. So what are the four things? I think one thing to point out is rig efficiency. I've been hearing a lot about rig efficiency and talked to an operator this morning who, with their 8 rigs that they're running now versus 17 a year ago, those 8 rigs, they're expecting them to be able to drill 2 wells per month per rig. So we have seen rig efficiency double since 2013. In 2013, it took almost a month and a half for a drilling rig to drill a well from spud to TD, and now companies are expecting those remaining 73 rigs, they are just that good at what they do, to be able to get 24 wells a year out of each one of those rigs. So we can't really compare 73 rigs to 190 rigs even a year ago, because those remaining rigs are just so very, very good at what they do. The second thing is where they're drilling. The well results are so much better even than they were a year ago. I compared IP rates May versus May a year ago. And a year ago, there were 24 wells that came in at less than 500 barrels a day initial production rate. And in May of 2015, no wells less than 500 barrels a day. In fact, there were 3 wells that were over 3,000 barrels a day and no wells over 3,000 barrels a day a year ago. So the core area that they're drilling in is just far more productive as well. So not only are the 73 rigs able to drill twice as many wells, but the wells are 25% better than wells were a year ago. Well costs are down $1 million a well and continue to drop. Companies are reporting that frac costs are coming down now, so not just rig costs and rig efficiency, but frac costs are coming down as well. So that may lower that $65 price point to $60. That's kind of the hope, is over the next 6 months that will drop by $5, both that and the rig cost. And then the last thing, of course, is gas capture. A year ago, we were at 73%, and we're at almost 83% today. So those are the fantastic four things that came out of the May production. And I was surprised by the large increase in production. I expected May to be a down month and June to be an up month. I still expect June to perhaps be an up month, and we may break a record in June. We've been managing non-completed wells pretty carefully. As we talked about, June was the first month when folks started hitting that 1 year time limit. We went into the month with 125 wells in that category and exited it with 20 folks in violation. So they've all gotten their letters, and they've got a brief period of time here. They've got 6 months to get that well on production or get approval to temporarily abandon the well or to plug it. And obviously the last category is very unlikely for a brand new well. If they don't act in that 6 months, then they're going to have to post a full plugging and reclamation bond. And those bonds are going to cost them $200,000 plus per well. So, there's going to be a lot of pressure on them to get those wells on production before the end of the year. As we look out, those numbers kind of quiet down. There's only 20 wells that hit that 1 year mark in July and 10 in August. But at the end of the year, it really picks up 100 in December and 107 next January. So June should be an up month. We'll have probably some down months, and then at year end, there's going to be a lot of non-completed wells that are going to have to be brought on. So a lot of stuff in the numbers, but four really big takeaways. Double the rig efficiency of 2013, 25% better IPs than a year ago. Well costs are down $1 million a well and dropping, and gas capture's up.
What is the time frame for the costs on well completion? Is it when did you compare that from when to when?
Oh, I'm comparing a 2014 first half average versus a 2015 first half.
Mm-hmm.
So those wells, I'm sorry,
Go ahead.
waiting completion that you think will come online December, January, what will that do for production?
Yeah, the wells, the question was those wells waiting on completion, 100 in December and 107 in January, what does that do for production? And that should push production up in those months, maybe 25, 30,000 barrels a day. So I just really expected that industry's going to find it pretty easy to stick at that 1.2 million barrel a day mark. I took a look. There are 925 wells in that inventory at the end of May, so still a large inventory. And if you look at the capacity of those 73 rigs to drill 80 wells a month and or more, and then working out that inventory, theoretically, it could take them 24 months to work through that 925 well inventory. So the wells already exist, and the rigs are already working to sustain 1.2 million barrels a day for 2 years. I think people are hoping prices increase and we can go back into a growth mode, but we're capable of sustaining production for a couple of years.
And is there energy to do that? Does industry want to do that? Would the state prefer that?
Yeah. The question is that what everybody wants? And the answer would be yes. The state obviously built its budget and its revenue forecast around 1.1 to 1.2 million barrels a day, and current oil prices are a little bit higher. And industry has figured out how to manage its cash flow and its capital investment by using a combination of high efficiency rigs and working off of that NC well inventory. So that's going to be the MO for the next year, maybe 2 years. I looked at the most recent couple dips in oil price and oil activity, and one of them lasted 15 months and one lasted 115 months. So I can't bracket it very good. Obviously, everybody's hoping for the 15-month downturn and not the 115-month downturn, but we're capable of working through something like that.
And did I hear, oh, I'm sorry. Go, Mary.
Quit on the show. Finish
I
up and then
apologize,
Mary
I'll be
Kate.
done. So then the 24 months you just mentioned, is that how long you think we can maintain that level of production with the number of rigs that we have going? Did I hear that
Yes,
correctly?
yeah.
Okay.
The answer was, with the number of rigs we have going, how long could we sustain 1.2 million barrels a day? And we could manage it for 24 months
Okay.
Based on the non-completed well category or inventory we have and the capability of these 73 rigs.
Okay.
It's pretty astounding just how good they've gotten at what they do. And they're drilling wells in packages of 6 to 8, so they're batching 6 to 8 wells at a time, and that helps with the rig efficiency as well.
Okay, I'm going to take one from the webinar just to keep it consistent. The $65 to $75 barrel prices you mentioned as benchmarks, are you mentioning that as WTI prices, or is that North Dakota price that we quote?
Yeah, that's a great question, and those are WTI prices.
Okay.
So everybody's familiar with those, and so most of the companies use that as their marker, and they factor into their economics the discount. So those are WTI prices of 65 and 70, and the hope is they can continue to make improvements in well costs and push those down $5.
Do you have the volume of gas flared in May with you? And then along those same lines, can you expand as to why the expansion of gas gathering south from Lake Sakakawea remains delayed?
Okay. You may have to repeat the second question.
Okay.
It was rather long.
Okay.
And it had Sakakawea in it.
Yeah.
I got distracted. I apologize. The volume in May was 293 million cubic feet a day. So it was up 23.5 million a day from the April volume. So you're right. I mean, it's good to focus not just on percentages, but volume as well, because what we're really after is a volume decrease. The second part of the question had to do with
Expansion of gas gathering south of Sakakawea remain delayed. Can you expand on that?
very serious problems there. And the Hess project to move gas across Lake Sakakawea continues to be postponed. The Bureau of Land Management has a tough decision to make. And I spoke with them this morning, I spoke with Hess this morning. They say that they have 1 week to 2 weeks at the most to get that decision, or we lose the entire construction season and we build it next year. So we're down to absolute crunch time on that. That currently is stranding, originally it stranded, I think it was close to 50 million a day. Hess has found some ways to work around that. And so right now they've gotten that stranded gas down about half to 25 million a day, but still very significant. The other stranded gas, the 40 million a day that fell through because of the Long X pipeline, is just going to have to wait for about 15 months. There is no way to get that pipeline in the ground this season, and the construction is underway on the Bear Creek plant, and that'll come online hopefully into September 2016. So major bottlenecks south of the river.
Okay. Mary Kate?
So if I could ask, when rigs started dropping off, there was a discussion of the jobs lost. With rigs becoming more efficient, if prices were to recover, will the majority of those jobs ever be able to come back since they've gotten so good at streamlining? Yeah,
very good question. Significant job losses going from 190 drilling rigs to 73. I haven't done the math, but you can figure about 120 jobs for every one of those rigs. So 120 times 120, maybe somebody that can do math quick in their head while they're talking can come up with that, but that's a lot of jobs.
14,400.
14,400 jobs. I should have known 12 times 12. I think with the improving rig efficiency, discussions from the industry is that we're unlikely to ever get back to 190 drilling rigs. And that, so guesses are that 40 of those rigs, 480, 500 of those jobs are gone for good out of the 14,000. At least 500 of them, permanent.
Yeah, actually, it was a follow-up on hers. Are there other areas in which systems are becoming more efficient so that we might not see as many jobs come back besides drilling?
Yeah. The question was, are there other areas of the industry where there are big improvements in efficiency and we may not see as many jobs come back? And the answer would be yes, the most obvious one being the difference between trucking all these fluids and the pipelines. We've been meeting with gathering companies for the last week, and we've got about another week to go, but they haven't slowed their construction or capital investment activity at all. And so we're going to see a continuing major shift of oil and water traveling by pipeline versus trucking. So we're going to see permanent job losses in that trucking industry as well.
And this is a good follow-up to that, since you talked about midstream investment continues to happen. Can you explain a little bit as far as pipelines, the jurisdiction between DMR and the Public Service Commission? Because I think some folks on the line have questions about that.
Yes. So when we talk about midstream companies, we talk about gathering pipelines. And gathering pipelines are under the jurisdiction of the North Dakota Industrial Commission, Department of Mineral Resources. Transmission pipelines are under the jurisdiction of the Public Service Commission. And that line between the two is laid out in statute. On a gas pipeline, that's a gathering pipeline right up to the chain link fence that goes into the gas plant. So all the way from the wellhead to the gas plant, that's a gathering pipeline, and that's under Industrial Commission. Saltwater, 100% Industrial Commission. Public Service Commission doesn't regulate saltwater pipelines at all. On the oil side, it's when the first point where there's a pump and a tank in combination that stores some oil and boosts the pressure. And then at that point, from there downstream, it's Public Service Commission. So gas and saltwater are very clear. Oil is a little more tricky. You got to find that first pump and tank in combination. So most of the 3,000 or so miles of pipeline that are going to go in the ground this year are going to be Industrial Commission gathering pipelines.
I think
You had said that the well costs have gone down about $1 million. A big part is due to fracking companies dropping prices. How are they doing that? Were they just that high price before, or how are they tightening their belt? Or are we going to see companies going out of business because they're just not profitable?
Well, I think there's some of everything. So the question was, with fracking companies lowering their costs, how are they doing that? Part of it was demand was so high at the peak that the profit margins were very, very good. Another part of it is that they're reducing manpower and they're reducing capital investment because they're completing 110 or 120 wells a month instead of 200. But another big part of it is that they have found more efficient ways. One of which is they're using a lot more sand and a lot less high strength or ceramic proppant. They've actually found that in the part of the basin that they're drilling in, that high volumes of sand work better than the high strength proppant, and it's far, far cheaper. And chemically, they're using a lot more water, but a lot less chemicals on a percentage basis. So they've found a lot of ways to reduce costs.
And that actually piggybacks into a question that I was trying to figure out how to fit, but You made it work for me.
Whoops.
A lot more sand, no, it's good, he'll be happy. A lot more sand now being used. Do you think that'll be the norm? He says comparison of, say, 6 million pounds to about 2 million. Do you think that's the norm?
No, that's correct. Everybody is headed or has already arrived at that 10 million pound point on their hydraulic fracturing jobs. Early on, companies were trying to get longer fractures and prop them open using high-strength proppant and that sort of thing. What they've actually found is they're getting 25% better wells by going for shorter fractures with a lot more sand packed into them. So they don't need high-strength proppant. They need a lot higher volume of water and sand. But the wells, not only are the initial rates 25% better, but it looks like the ultimate recoveries are 25% better as a result of very complex, short, fat fractures.
Okay, I have a lot of random questions here that fit but don't tie together, so no good transition, so I'll just try to go in order here. Any production impact from oil conditioning rules and any non-compliance in that field?
Good question. Production impact from the conditioning rules. The gathering midstream company I met with this morning indicated that they're seeing a significant increase in liquids in their gas gathering system, somewhere between 0.2 and 0.4 gallons per MCF. That corresponds to maybe about a 1% to 2% drop in oil volume. So that liquid is being boiled off of the oil and is ending up in the gas gathering system, really where it belongs, instead of in the crude oil. So yes, there are some decreases. You asked that was a longer question than that.
Any non-compliance issues?
Non-compliance issues, yes, thank you. We had so far 99% success rate, companies achieving the vapor pressure requirement. About 1% have failed the test, but have adjusted their equipment and come into compliance within the 48-hour window. We're really just getting through our first treater survey, and out of roughly 9,000 plus, a little over 9,000 heater treaters, we found 900 of them that were not in compliance. So they have to be revisited now this quarter. We're into a new quarter in July to see if they've come into compliance. If they haven't, I think we're going to have to order those companies to switch to the vapor pressure testing. If they're having serious problems getting their treaters in compliance, that's not a bad rate, but it still represents over 10%, or right at 10% of the treaters that were out of spec in order to get the oil results.
Just going back to something you said earlier, production is flat on Fort Berthold, but up statewide.
Mm-hmm.
Why is it flat on Fort Berthold?
The question was, why is production flat on Fort Berthold and up statewide? We have seen a much more significant drop in rig count on Fort Berthold and on well completions. And a lot of that has to do with the political turmoil and regulatory turmoil that's going on there right now. There's a shift towards very localized regulation and a lot of changes going on. So the drilling activity and the completion activity has fallen off much more significantly on Fort Berthold than off.
Any companies that you could, or maybe can you put a number to companies that have just stopped drilling entirely? The question really is how many companies are drilling, and I referred to the active drilling rig list to take a look at that, but any that you can think of that just they had to stop drilling entirely? They had to just lay everybody down, or is just everybody reducing it, just efficiencies?
The vast majority has just been reductions, but there have been some companies, for example, Slauson, who went to 0 rigs. And if I thought for a while, I could maybe come up with a few more. In fact, I was, let's see if I can find my little drilling thing here. Oxy completely quit drilling. Slauson completely quit drilling. Marathon almost quit. They're running one rig. And Savannah occasionally runs one rig, but sometimes runs zero as with WPX. So yeah, there's a handful of companies that went to zero some weeks and one rig occasionally.
Are the efficiency improvements and well cost reductions enough to sustain production growth like May for the rest of 2015?
Yeah, I anticipate that we'll exit 2015 pretty much where we're at. Maybe even with the large number of wells that have to be completed in December, we may even exit a little bit above the May production. But the strategy appears to be, as long as we're stuck in this $55 to $60 oil range, to just sustain production and sustain cash flow with as few rigs as possible and fracking wells in the inventory.
Okay.
Just kind of I'm not sure if it's too out there, but I know that money is a big driver behind when to frack and not to, but do seasons kind of play a role in that at all, in terms of people wanting to frack wells in summer versus winter, even if that's in the completion time set?
Yeah, so the question was seasonality along with money, and absolutely, that is a significant driver. Cash flow or the return on investment being the biggest, but frack costs can run 30 to 50% higher in January and February than they do this time of year. Just to heat the water for a 10 million pound, 10 million gallon frack can be $250,000 in January and February. So, when you're talking about spending $3 or $4 million on a frack job and you have to add $250,000 to $300,000 to it just for heating the water, yeah, they really try to avoid trucking and fracking in the wintertime.
To do the numbers, is the January tax decrease going to level, whatever they would spend on that heating the water, would it be evened out by the tax free?
That's a great question. If you do the numbers, will the decrease in the oil extraction tax pay for fracking wells in January? I don't know if they get quite that granular on it, but we're going to have Commissioner Rauschenberger back, right? Isn't that our plan?
Sure.
So yeah.
You say so. You betcha.
I think we need to invite him back just to talk about what this second dip in prices means or would have meant in a tax trigger environment, and whether there's a possibility that we could yet hit the big trigger for a month. Because right now, July prices are averaging below the trigger price. So that is out there, depending on how long this dip would be. The possibility that we hit the big trigger in November and then it goes away first of the year. So we'll bring him back and talk about that.
All right. Well, I don't see any other questions. We're running up against the timeline, so we'll just cut it there. I just want to let everybody know if you have any follow-up questions this afternoon, I'll do my best to get back to you. However, my second child is running a fever this week, so I will be going right back home at the end of this webinar. So I'll do my best to get back to you. I tried to take some really good notes. But if I don't get back to you right away, sorry, but mama roll comes first. Secondly, next week, if you all are looking to get a hold of me, I will be in and out of the office in Western North Dakota next week doing some talks all over the place. Cookfest, some NRCS meetings, and then finally on Friday, a trip to Iowa. So I'll be hitting this next week, so just hit me up by email and I'll get back to you as soon as I can. So with that, it should be a lovely transition into our friend Mr. Kringstad.
Well, good afternoon, everyone. Happy Friday. And so we'll get into the midstream update from the Pipeline Authority here. So moving along into the production side, you can see, again, holding steady in South Dakota. For the year of 2015, I've been struggling to get county specific data out of Montana system. And so as soon as I can get that, I will get this updated. The EIA does have some data on Montana as a whole, but not those eastern counties, and so I've been using that as a gauge to try and understand where production's going for the estimates you see coming up. But I didn't forget about eastern Montana here. I've just been struggling to find the county-by-county data for the first part of this year. And then again, just looking back at 2014 for reference. In May, again, just a slight shift in the transportation dynamics. Some more barrels moving towards the pipeline systems and into the new refinery that opened up in May. And so you'll notice the new category, that red portion of the pie used to say Tesoro Refinery. Tesoro is no longer the only refinery in the state, and so I had to change it category just to refine. So that now does include the Dakota Prairie Refinery in Dickinson and the Tesoro Refinery in Mandan. So you'll see that slight uptick in the numbers here going forward. And just a reminder for those who aren't familiar, Dakota Prairie Refinery, a 20,000 barrel per day diesel topping facility in Dickinson. And then again, just looking at some of the dynamics with price included on this chart. And so again, getting back to the similar trend that we've seen historically, as that Brent WTI spread narrowed again in that April-May timeframe. We did see more barrels shift towards the pipelines and a percentage drop and volume drop on the rail movements out of the region. When we look at, on slide 6, the overall estimates for how much oil was moved out by rail, again, you see another dip now below 700,000 barrels per day estimated to be leaving the region by rail car. And for the last couple months, we've seen pretty steady on the amount of truck traffic going in and out of North Dakota, crossing over into the Canadian side of the Williston Basin. And so going forward, that's very dynamic, as you can see in this chart. And so we'll continue to monitor that for the overall balance of how those barrels are being moved around the region. Just a snapshot of that Brent WTI price triggers right now, not triggers, but the differential, just under $6 as we sit here today. So again, not a lot of change expected from percentages based upon this driving factor. Slide 9, looking at the flaring percentages, again, just off 1% from Lynn's because of the non-confidential data. But we did see a shrink in both categories from the last time we've met, both in the amount of gas flared from wells connected versus unconnected. And so you'll see on slide 10 then, some significant progress in the number of new wells connected to the gathering systems in the month of May. So that you can see, if you look at that chart real closely, kind of the wintertime lull, where we saw a slowdown in well connections just because of winter working conditions, but then coming out into the more favorable time period, more well connections, and we expect this type of pace to continue going forward. So with that, I'd be glad to answer any questions.
Go ahead.
Yeah, question about the truck imports and exports.
Yes.
Can you so what is that? Is that crude oil being moved by truck into Canada?
Right, so the question for those on was just explaining a little bit of the truck imports, exports, and so what that is, yeah, there we go. So slide 7, what we're looking at, those are barrels moved by truck and through the Canadian U.S. ports. They get tracked by the U.S. International Trade Commission. And
So red is
barrels coming into the U.S. from Canada, and then the black line is North Dakota or Williston Basin barrels on the U.S. side moving into the Canadian system. And so people do that for various marketing reasons, system configurations. They may be right on the border of North Dakota and Canada, and the nearest injection point may be on the Canadian side of the border versus, on the U.S. side.
And why have the imports fallen off so much?
It's my explanation for that was we're likely seeing quite a few barrels coming into North Dakota to access our rail network. What we saw earlier this year was a rail facility in Canada expand and provide additional service for rail transportation out of the Canadian side of the play. So likely when we saw that dip down was correlated to when that rail facility expanded.
90,000 barrels a day, is that the 2 refineries that you're talking about?
Correct. So when we look at that 6% of the overall production, that would include both refineries, 70,000 barrel a day Tesoro refinery, and then the 20,000 barrel a day Dakota Prairie.
Any idea if the Clearbrook prices are staying close to WCI?
I have not seen any data recently on the Clearbrook differential, no.
I see.
Is it because of construction season that it looks like, at least in the last 2 years here, that May always dips for rail export? Is it because construction of pipelines kicked in and so the rail goes down, or is there some kind of unique reason that we always seem to dip right around May?
The question was, looking at the kind of historic rail estimates of kind of a downtick in the May time periods. That, no, I haven't made any conclusions as to if there's a logical explanation for that or if it's just coincidence the last couple of years, so.
I have one more.
Yep.
What do you think the impact on crude by rail will be of the Dakota Access and Sandpiper pipelines?
Yep, so the question was the impact on rail movements going forward. This is the big question that everyone's asking. What happens to rail movements when Dakota Access, when Sandpiper, when the other projects are in the works go online? I hesitate to try and make any type of forecast because there's so many unknowns as far as where production levels are going to be. What we do know is that barrel is going to move either by rail or by pipeline. And those pipelines get built based on commitments to those projects. And so those barrels that would have been utilized in a rail system, they're committed, they're going to be moving on those pipeline systems. But again, there's just so many different market unknowns or uncertainties to try and say X, Y, Z is going to happen for sure when these projects come online. But we will see a significant shift. You know, what percentage-wise or barrels-wise, that, you know, is difficult to put a number on, but there will be a shift, most certainly.
From rail to pipeline?
Correct, yes.
Okay.
I don't know if this makes sense, but you mentioned ones that don't have, the barrels that don't have a commitment either way can kind of choose to go between pipeline and rail. How many companies just have ones that can move that fluidly from the different modes of transportation, or most of them kind of locked in one way or another?
Yeah, so the question was on those shippers of the rail or the pipelines, you know, how do they manage their commitments, whether it's pipe and rail? Some of the larger companies, you may see them diversified, where they'll have barrels committed on various types of systems to try and manage what the different market conditions are. Some companies are solely dedicated to rail, some are solely dedicated to pipeline. And so it varies depending upon how each company manages that side of their business. So
They can't really change it week to week depending on price, be like, I'm going to pull this one over here and that kind of thing.
if it's an uncommitted barrel, you know, there's some flexibility as far as, you know, looking at the market conditions. Do we access open space on a pipeline? Do we try and get on the rail network or, say, the East Coast or West Coast? So there is that gets, you know, looked at on a probably more of a monthly basis rather than a daily or weekly, but there is some flexibility for those uncommitted barrels.
Are you asking, like, what percentage are uncommitted?
Yeah, is there like a large amount of these ones that are just kind of floating between the two?
For that, I don't know, you know, for a new project, you know, they typically want to be 75% plus committed on a major new project. But some of our legacy systems, as far as what they have with their specific customers, that information, I don't know is publicly available anywhere.
Okay. Nothing else? Then I think we'll call it a director's set.
Okay, thank you.
So, thanks, everybody.